Hi, my name is Alex Carlucci with Gus & Show Associates. I want to talk to you about non-QM loans and the types of products that we do for those loans. So non-QM stands for non-qualifying mortgage. What that means is that they don't fall into these QM fails, that a loan can't be done because the interest rate's too high or the cost is too much. You can't charge borrowers 5 points on a regular FHA loan. It's called a qualifying mortgage fail, so QM. So the non-QMs will do things that other banks don't do. And the reason they have to be called non-QM probably is because of the cost of the loan and the high interest rates, because they do come with high interest rates. But what they do is that, let's say you're self-employed and you write off all your expenses on your tax returns and you show zero profit. Well, let's say you're really pocketing $500,000. Well, the IRS allows you to deduct it, even though you're probably pocketing more. I don't know how that all works, but these non-QM loan investors, they're hedge funds that are backing this, have determined that some of these people are worthy of getting a loan. Just because they deduct things on their taxes doesn't mean they shouldn't qualify for a loan. Because we're not going to look at their tax returns, we're going to ask for 12 months business bank statements and determine what their income is based on the deposits and the industry that they're in. They have income there that they feel that it's valid income and they qualify for a loan. Now they're going to charge them a higher rate, maybe 2 points above the market rate, maybe 4 depending on the credit score. They're also going to charge them points. So these would make them non-qualifying, but they're doing things without verifying tax returns and job. You're going to your employer and getting HR verification of employment. So what they do is the bank statement loans. That's a very popular one. They do what's called the DSCR, which is debt service coverage ratio. That means that they'll do a no-doc loan. If you're buying an investment property, let's say 20% down, and if the rent covers the mortgage payment, you're golden. But you're going to charge a higher rate. So if the debt of the house is 0 or better, so it means you're making a profit or scratching, you don't lose any money, then they can do it. And they don't even ask for what you do for an income. They're just qualifying off the property. And again, the 20% down is going to give them a little cushion in case you were to go under. Now, we do have a brand new one that's out 15% down, so we can actually do an investment DSCR with 15% down, brand new. We also have a true no-doc, just no documentation at all. If you have a 640 credit score above, then you can do a no-doc loan. They ask for a 1-month bank statement to show you the 20% down on this loan. And if you have a 640 to 680, it's 18 months reserves. 680 to 740 is 12 months reserves, and 740 and above is 3 months reserves. What reserves are is money in the bank after you close left over for mortgage payment. So if your mortgage payment's $2,000 and you need 3 months reserves, you need $6,000. Three months, because you got a great credit score, times the $2,000 mortgage payment, that's $6,000 left over in the bank after you close. Reserves on this product have to be your own money. The 20% down can be 100% gift. And this is for primary residences, not for investment. So we have the DSCR for investors, and then we have the 20% down for owner occupants. So we can do no-doc, we can do bank statements. We also have a 1099 program. So let's say you're 1099, but you write everything off. You have to be 1099 for the last 2 years. We'll do off 90% of that 1099's face value. So if the 1099 says $100,000 a year, we'll take 90% of that. That's $90,000 a year. That's your income. They're not going to verify your tax returns. These programs are for people who really do make money, but they take advantage of the tax system and they write things off. They have deductions. They have business expenses. And underwriters or hedge funds realize that there's a lot of successful people out there that do that. Some guy's really making $1 million a year, but he only shows $80,000 adjusted gross income on the tax returns. And that guy wants to buy a $1.5 million house. We can do it. These non-QM loans go up to $3.5 million. So these are meant for really, successful people. These are not just meant for anybody. They do have minimum loan amounts. 100,000 is our absolute minimum. Most of them are 150, but we do have one that will go down to 100,000. So they're not for the smaller houses. It's for at least 150 loan amount in general. So you can't buy an $80,000 house with this. Again, it's all about the assets you have and the bank statements you can provide, or the type of property you're going to buy. That's rent, it's investment, it's going to cover it, or you're buying a primary with 20% down. We can do it. So 15 for investment, no doc, 20% down, no doc. Bank statement loans, now you get a better rate with the bank statement loans than you do with the no doc, so keep that in mind. And a lot of these loans come with points, discount points, and you be prepared, you gotta pay for it, for the rate. Sometimes you gotta buy the rate down just to qualify. Sometimes you gotta just pay the points to get that good rate. So be prepared for some higher cost, but these loans are getting people in the house. If it's owner-occupied property, you can refinance in 6 months if you qualify with full documentation with no penalty. On the investment programs, there's usually a 3-year prepay. It's usually 3, 2, 1, I believe. That means 3 points the first year, 2 points the second year, 1 point the third year. What that point means is you have to pay 3 points times your loan amount if you refinance it as a penalty. The second year is 2 points times your loan amount. So 300,000, 2 points would be $6,000. So 1 point would be $3,000, 3 points would be $9,000. So you just multiply the points by the loan amount, and that's what you have to pay to get out of that loan if you want to refinance out sooner than the 3 years. So if you got any questions on this, we specialize in it here. We got some really talented people that know these products pretty well. I'll transfer you to them if I feel like that's who you need to talk to. But give me a call. We are specialty people at these loans. It didn't come out right, but we're specialists. So give me a call. My phone number is 630-915-7550, and please hit subscribe. It helps us help you, and the like button helps me. Thank you.